Hello and welcome to today's economic update. Over the past week, tensions between the United States and China have intensified, impacting global trade, financial markets, and economic policies. Let's dive into the key developments shaping this conflict. 1. U.S. raises tariffs on Chinese imports. China hits back on March 4th. President Donald Trump signed an executive order increasing tariffs on all Chinese imports from 10% to 20%. Citing national security concerns and fentanyl trafficking as key reasons. In response, China announced retaliatory tariffs on U.S. agricultural products effective from March 10, imposing a 15% tariff on wheat, corn, and cotton and a 10% tariff on soybeans, pork, seafood, and dairy products. Additionally, China's Ministry of Commerce launched an anti-circumvention investigation into U.S. optical fiber products and suspended imports of U.S. logs, marking a further escalation in trade tensions. 2. China files WTO complaint against U.S. tariffs on March 6. China officially filed a complaint with the World Trade Organization, challenging the latest U.S. tariff hikes. Beijing argues that these tariffs violate international trade rules and has demanded formal negotiations within 60 days. If no resolution is reached, China may pursue official arbitration to seek a WTO ruling against the U.S. 3. Global markets react to escalating trade war. The U.S. stock market has suffered significant losses due to uncertainty over tariffs and global trade stability. On March 5, the Dow Jones Industrial Average dropped nearly 800 points, erasing months of gains. The S&P 500 and Nasdaq also fell over 2%, reflecting investor fears of an economic slowdown and rising inflation. Meanwhile, in China, imports declined by 8.4% year-on-year in January and February, showing early signs of trade war repercussions. The U.S. dollar weakened, while the euro saw its strongest weekly gain in 16 years, jumping 4.6% against the dollar. Even crude oil prices dropped 4%, reflecting growing concerns about global economic instability. 4. Panama Canal deal. Li Ka-shing sells strategic port assets in a surprising move. Hong Kong billionaire Li Ka-shing C.K. Hutchison Holdings has sold a majority stake in its Panama Canal port operations to a U.S.-led investment group, including BlackRock. The $22.8 billion deal involves control over two key ports on both sides of the Panama Canal, a crucial global trade route. While C.K. Hutchison claims the sale is purely a business decision, analysts suggest geopolitical pressures, especially rising U.S.-China tensions, may have influenced the move. This sale reduces China's foothold in a critical international shipping route, a development closely watched by policymakers in Washington. 5. U.S. Treasury restricts investments in China's high-tech sector. The U.S. Treasury Department has implemented new investment restrictions on China's artificial intelligence, semiconductor, and quantum computing industries. The move aims to prevent China's military from acquiring advanced U.S. technology. However, Beijing has strongly condemned the decision, calling it an unjustified economic blockade. These restrictions further strain U.S.-China financial relations, adding another layer of complexity to ongoing trade disputes. 6. Hong Kong's changing financial landscape as tensions rise. Beijing is strengthening its control over Hong Kong's financial sector, reducing the influence of Western financial institutions. In the past 2 years, Western banks' participation in Hong Kong's IPO market has dropped from 50% to just 20%, while Chinese banks have taken a dominant role. This shift signals Hong Kong's transition from a global financial hub to a market increasingly aligned with mainland China. At the same time, U.S. lawmakers are raising concerns that Hong Kong is becoming a center for financial crime, including money laundering and sanctions evasion. A group of U.S. Congress members has urged the Treasury Department to review financial ties with Hong Kong, warning of potential risks to U.S. investors and businesses. 7. China's economic resilience and policy adjustments. Despite trade war pressures, China's economy remains resilient. The government recently revised its 2023 GDP growth estimate to $17.7 trillion, reflecting a 2.7% increase. However, challenges remain, including a sluggish real estate market, rising unemployment, and weakening consumer demand. To counteract these risks, Beijing has introduced stimulus measures, such as expanding export credit support, investing in public services, and encouraging domestic consumption and infrastructure spending. While China remains firm in its trade war strategy, analysts warn that prolonged tensions with the U.S. could impact long-term economic growth. Conclusion: a prolonged economic battle with escalating tariffs, market volatility, and shifting global alliances. U.S.-China economic relations are on a downward trajectory. Both nations are digging in for a prolonged trade conflict, with businesses, investors, and policymakers watching closely for further developments. Will negotiations ease tensions? Or are we entering a new phase of economic decoupling? Only time will tell. That's all for today's update. Stay tuned for more insights on global finance and trade.